Hello friends, welcome back to the channel, and I need to talk to you today about something that nobody wants to think about, but everybody needs to hear. When a UK pensioner dies, their bank accounts are frozen. Not after a review, not after a grace period, immediately. The moment the bank is notified of the death, every sole account in that person's name is locked, and the family cannot withdraw a single penny. Not for the funeral, not for the mortgage, not for the energy bill that is due in 4 days, not for the care home invoice that has already been sent. Nothing. The account is sealed, and it stays sealed until a legal process called probate is completed. And probate does not take a week. It takes weeks, sometimes months, sometimes the better part of a year, and during that entire time the family is expected to cover every cost out of their own pocket, while the money their loved one left behind sits in an account they cannot touch. I have gone through the current rules on account freezing, the probate process, the intestacy framework, and the specific steps that banks, pension providers, and insurers require before they will release a single pound. And what I have found is that there are 5 things a pensioner can do right now, while they are alive and well, that will determine whether their family receives their money quickly and in full, or whether they are shut out for months, overtaxed, or in the worst cases, left with nothing at all. I am going to walk you through all 5. No jargon, no legal waffle, just the steps, the figures, and the one action for each that separates a family that is looked after from a family that is left behind. Now, before I get into it, I want to say something to those of you who are subscribed to this channel. Thank you. You understand that these are not things the bank explains to you when you open an account. These are not things your pension provider prints on the front page of your statement. These are rules buried in policy documents and legal frameworks that only surface at the worst possible moment, when someone has died and the family is already in shock. The people who subscribe to this channel learn about these things before that moment arrives. The people who do not subscribe learn about them in a solicitor's office, weeks after the funeral, when the options have already narrowed. If you are watching this and you have not subscribed, now is the time. One tap. And the next time something this important comes up, you will hear it first. Now, there are 5 things on this list, and I want you to stay until the very end, because number 5 is the single largest amount of money most pensioners will ever leave behind. It is the one that most families lose the most time and tax on, and it is the one that can be fixed in under 10 minutes with a single form. Let us get into it. The first thing is the bank account itself, and the difference between a sole account and a joint account, because this one decision, made years before anything happens, determines whether your surviving spouse or partner can pay a bill the day after you die, or whether they are locked out for months. If you hold a bank account in your name alone, a sole account, it is frozen on death. Full stop. Your wife, your husband, your partner, your children, nobody can access it until probate is granted. But if that same account is held jointly, in both your names, the surviving account holder retains immediate access to the full balance from day one. The money does not go through probate. It does not get frozen. It passes automatically to the surviving joint holder by what is called the right of survivorship. For married couples and civil partners, converting a sole current account or savings account into a joint account is usually straightforward. Most high street banks will do it with a single appointment or a phone call. It costs nothing. And it means that on the worst day of your partner's life, they are not also standing in a bank being told they cannot access the money they need to bury you. If you have a sole account and a spouse or civil partner who would need access to that money, make it joint. Do it this week. 1 appointment, 1 conversation, and a problem that devastates families is removed before it ever begins. The second thing is your will. And I know you have heard this before, but I am going to tell you what happens when you do not have one, because most people do not actually know. If you die without a valid will in England and Wales, your estate does not simply go to your closest family member. It is distributed according to a rigid legal formula called the rules of intestacy, and those rules do not care about your wishes, your relationships, or your promises. If you are married with children, your spouse receives the first £322,000 of the estate and half of anything above that. The rest goes to your children. If you are not married, your partner receives nothing. It does not matter if you have lived together for 30 years. It does not matter if you raise children together. It does not matter if every neighbor on your street considers you a married couple. In the eyes of the law, an unmarried partner has no automatic right to inherit a single penny. Stepchildren receive nothing unless they have been legally adopted. Close friends receive nothing. Charities you supported for decades receive nothing. Only a valid will overrides the intestacy rules, and according to the most recent data, more than half of UK adults do not have one. You can write a will through a solicitor, typically for between £150 and £500 depending on complexity, or through a reputable online will writing service for significantly less. If your finances are simple, a basic will can be completed in a single sitting. But it must be signed, witnessed, and stored properly. Do it. Do it now. Because a will written today protects everyone you love tomorrow, and dying without one is not leaving things to chance. It is leaving things to a formula that was not written with your family in mind. The third thing is one that most people have never been told, and it involves life insurance. If you have a life insurance policy, whether it is a whole-of-life plan, a term policy, or an over-50s plan that you pay a small monthly premium on, I need you to check one thing. Is the policy written in trust? If it is not written in trust, the payout when you die goes into your estate. That means it is subject to probate, which means delay, and it is counted toward the value of your estate for inheritance tax purposes. If your estate is above the inheritance tax threshold, currently £325,000, or $500,000 if the residence nil rate band applies, your family could lose 40% of the insurance payout to tax. 40%. On a policy you paid into for 20 years. But if the same policy is written in trust, the payout goes directly to the named beneficiaries. It does not enter the estate, it does not go through probate, it is not counted for inheritance tax. The money arrives faster and the full amount reaches the people you intended it for. Putting an existing policy into trust is usually free. Most insurers provide a standard trust form that you complete and return. One form, no cost. And the difference to your family could be tens of thousands of pounds. Ring your insurance provider and ask whether your policy is currently held in trust. If it is not, ask them to send you the trust form, fill it in, send it back. That is all it takes. The fourth thing is something that sounds obvious, but is responsible for billions of pounds sitting unclaimed across the UK right now. Tell someone where your money is. When a person dies, the family has to track down every account, every policy, every pension, every savings bond, every investment. And the banks do not come to you, the insurance companies do not come to you, the pension providers do not come to you. If the family does not know that an account exists, that account sits there. Dormant, unclaimed. According to industry estimates, billions of pounds are sitting in dormant accounts, forgotten pensions, uncashed premium bonds, and unclaimed insurance policies across the UK because the person who held them died and nobody knew to look. Write it down. Every bank account number, every savings account, every insurance policy number and provider, every pension, state and private, every NS&I bond, the name and address of your solicitor, if you have one, the location of your will, put it in a document, a letter, a folder, whatever you are comfortable with, and tell one trusted person where it is. Not in a locked drawer that nobody can open, not in a file on a computer that nobody has the password for, in a place where the right person can find it at the right time. One afternoon of writing down what you have and where it is could be worth thousands, tens of thousands, to the people you leave behind. And now the fifth thing, the one I told you at the start to stay for, the one that involves more money than almost any other asset a pensioner holds, and the one that can be fixed faster than any other item on this list, your pension pot. If you have a defined contribution pension, which is the type where money is invested in a pot in your name, and you die without having completed a nomination form, your pension provider does not automatically hand that pot to your spouse. It does not go to your next of kin. It does not follow the rules in your will. It goes to the pension scheme trustees, and they decide who gets it, when they get it, and how much tax is deducted first. In many cases, that decision takes months. In some cases, the trustees distribute the money in a way the deceased would never have chosen. And here is the part that makes this so urgent. If you die before the age of 75, your entire pension pot can be passed to your nominated beneficiaries completely tax-free. not reduced, not partially exempt, entirely tax-free, but only if you have completed a nomination form, an expression of wish form, telling the pension provider who you want to receive the money. Without that form, the trustees may still pass it on, but delays and discretionary decisions can push the process past critical tax deadlines, and the beneficiaries may end up paying income tax on every penny they receive. We are not talking about small amounts. The average defined contribution pension pot for someone approaching retirement in the UK is now well into six figures. For many people, their pension pot is the single largest asset they own, larger than their savings, sometimes rivaling the value of their home. And the difference between a nominated beneficiary receiving that pot tax-free in weeks and an unnamed next of kin receiving it months later with a tax bill attached is one piece of paper, one form. Log into your pension provider's website or ring them directly and ask whether you have a valid expression of wish or nomination form on file. If you do not, complete one today. It takes less than 10 minutes. You can name anyone you want, your spouse, your children, a grandchild, more than one person, in whatever proportions you choose. And once it is filed, your pension pot is protected, directed, and potentially entirely tax-free for the people you love. So let me bring this all together. 1. If your bank accounts are held solely in your name, consider making them joint so your surviving partner has immediate access and is not locked out by probate. 2. Write a will, because without one, the intestacy rules decide who inherits, and unmarried partners receive nothing, regardless of how long you have been together. 3. Check whether your life insurance is written in trust, because if it is not, the payout enters your estate, faces probate delays, and may be hit with 40% inheritance tax. 4. Write down every account, every policy, every pension, and tell one trusted person where to find it, because billions of pounds are sitting unclaimed because families did not know the money existed. And 5, complete a nomination form on your pension pot, because without one, your pension provider's trustees decide who receives it. The payout can be delayed by months, and a pot that could have been passed on entirely tax-free may be taxed at the beneficiary's income tax rate instead. 5 things, 5 actions. Every one of them can be completed this week, most of them in a single phone call or a single form, and every one of them is the difference between a family that is looked after and a family that is left waiting, locked out, and losing money they were meant to receive. If this video helped you today, I am going to ask you to do 2 things. Subscribe to this channel so you never miss a video like this one, and share it with someone who needs to hear it. A parent, a spouse, a brother or sister, someone who has been putting this off. You do not need to explain the whole video, just send them the link, because one share, one honest conversation about something nobody wants to talk about, that could make a real difference. Thank you for watching, friends. I will see you in the next one.